ለመማር ወደ ትምህርት ተቋም መሄድ ግድ አይደለም።
ናሽናል አቪዬሽን ኮሌጅ
ራሳችሁን ከኮሮና ቫይረስ ወረርሽኝ እየጠበቃችሁ በቤታችሁ ወይም በተመቻችሁ ቦታ
በኢንተርኔት አማካኝነት በኦንላይን ትምህርታችሁን መከታተል ይቻላል።
ካናዳ ከሚገኘው ኢንተርናሽናል ኤር ትራንስፖርት አሶሲዬሽን አያታና
ከእንግሊዙ ኢንስቲትዩት ኦፍ ኮመርሻል ማኔጅመንት ICM ጋር በመተባበር የሚሰጡ ትምህርቶችን ተከታትላችሁ በ6 ወር ጊዜ በዓለም አቀፍ ደረጃ ተቀባይነት ያለውን የስልጠና ማስረጃ ባለቤት መሆን ይቻላል።
ከኢትዮጵያ ሲቪል አቪዬሽን ባለስልጣን ሙሉ ዕውቅና ባገኘንባቸው የፍላይት ኦፕሬሽን እና የሆስተስ ስልጠናም በምዝገባ ላይ ነን።
ጥያቄና መልስ፣ የክፍል ስራዎች ብሎም ፈተና መፈተን ክፍል ውስጥ እንዳላችሁ አይነት
ልምድ ባላቸው መምህራን እየተማራችሁ
በኦንላይን ባላችሁበት ቦታ
አድራሻ ከ22 ማዞሪያ ወደ ሾላ ገበያ በሚወስደው መንገድ 150 ሜትር ገባ ብሎ ናሽናል አቪዬሽን ኮሌጅ
የናሽናል ኤርዌይስ እህት ኩባንያ
ህልሞን እውን ያደርጋል።
Good afternoon, everyone.
Good afternoon, Doctor. How are you?
Doctor. How are you?
We are fine.
How was the holiday?
It's good.
It's good.
Okay. So nice meeting you again. I remember the last time we met was on Saturday, and we could not meet on Sunday because it was a holiday. So we discussed several issues last weekend. Among them was the budgeting. We appreciated the purpose of budgeting, what budgeting is and what entails, the types of budgets, and the advantages and disadvantages of budget. And we were to look at the cost controls. And this is where we were to pick up from, the cost control. And when you talk about cost control, that's the work of managers. Managers basically, it is used, one of the tools that you use to measure the efficiency of management, because if a manager can control cost or can manage cost effectively, then it can be a means of evaluating the managers. So that's why it's important that as managers and given the course, management accounting, we understand why costs have to be managed and various ways of managing costs. Now, before we looked at that, we looked at issues of cost estimation, and then issues of costing of a product, or it could be a function, it could be an element, it could be a department. So we accumulate costs and be able to determine cost of a product. And that gave us different classification of costs for decision purposes. Now, when we talk about cost controls, there are various costs that we talk about particularly. We talk about material cost, because you have to buy some material, and then you are supposed to use the material to convert them into final products. Then you are also supposed to talk about labor cost, because labor is actually incurred in terms of production process. So for you to produce, you must have labor. Then we have the overheads. Overheads are those other expenses which we incur for purposes of production, but they cannot be easily identified with the production. And they vary. We have the variable overheads, we have the fixed overheads. variable overheads change with the level of production, or with the fixed do not change with the level of production. So now I want us to talk about cost controls first, and then after that we'll talk about the variances. We'll introduce the area of variances as part of trying to control costs, because variances just involves a process of comparing the budgeted costs against the actual costs that have been realized. So that is the essence of variance, and there are various issues that we have to address when we talk about variance analysis, which we'll come to after we have addressed the issue of controls. Now, the issue of controls will help us appreciate the work of management in terms of decision making, particularly to do with the production and sales, which are core functions of any organization. So allow me to share the screen so that we move together. After this, the controls, I will intervene your responses, and then we talk about variance analysis. Okay. I hope you are with me. Are we together?
Yes,
Anybody
doctor, we are
say
with
yes?
you.
Yeah.
Good, good.
Yes.
Yes.
Allow me to share the screen. So this is actually.
Where's Derek? Right there. Oh, what's up, D? Hey, what's going on?
I would request that we mute all of us, please. Let's mute
To my lovely
our.
wife, Jennifer Haynes. We actually have 5 kids and 3
Can we
grandkids.
mute our
Listen, and
microphones?
my wife, she was a single mom before we got married, and I had lost my job like right before we had got married.
Hello, can we mute? Very good, thank you. All right, cost controls. I hope you're able to see the screen. Are we? Cost control is a control of all items of expenditure by regular and frequent comparison of actual expenditure with predetermined standard or budgets, so that undesirable trends may away from standard can be detected and corrected at an early stage possible. So what you are saying here is actually, it brings us the purpose of controlling costs. And the main means of controlling costs is by establishing where things are wrong or where things are right, so that we know where to focus our attention in terms of control. And before we understand the cost controls, or we do any decisions to do with how to control costs, then we must understand how these costs are developed and how they behave. All right, the pattern of costs and all that is incurred as we do our day-to-day operations. So it is actually, it helps us in comparison with the budgets, now that we understand why we do budgets. So with the budgets and the actuals, we are able to identify areas of weakness, areas that we are incurring unnecessary costs, so that we find a way of addressing that and finding a possible way out that can minimize costs at the end of the day, or increase our revenues at the end of the day. So cost controls involves the following steps. 1, determination of cost standards for each item or element. So in every organization, we have standard costs. And standard costs here are basically expressed in terms of rates. For example, if there are laborers or people providing labor work or labor in terms of production, they are normally paid on hourly rate. So we use hours and a given rate, which is standard rate, that we can use to determine the cost that is paid towards the production in terms of labor. And this will help us in identifying where to control and where not. So we must come up with a standard cost. And it's either standard cost or a budgeted cost. So we must come up with the budgets, and mostly budgets are developed out of the standard cost. Then number two, the second step is finding out variations in cost from the standard. That is the actual and the standard. And what is actual expenditure compared with the estimated or budgeted expenditure. So you compare the actual with the budgeted. So we must have a process, a way of accumulating these costs. And then now, once they have been accumulated, we are able to now compare the two, all right? So the comparison comes after the costs have been determined and we already know what we have incurred during a given period. And therefore, with the standards which are always set at the beginning, it's easier for us to compare what we have incurred vis-a-vis what is given in terms of the standards. So taking corrective steps to ensure that actual costs are the same as the standard costs in future. So this is the purpose of controls now we're talking about. As managers, this is our work now. The step 3 is now our work to ensure that we operate within the standards that we have set ourselves. Because even setting up these standards involves some process. It's not just waking up and coming up with a standard rate. It has probably there are issues to be considered, the market rates, the prevailing market rates, the industry rates, issues of inflation, issues of all those are put in consideration before you arrive at the standard rate. And therefore, we are better off operating within the standards. So that's why if we have incurred the actual costs in a given period, it's important that we compare whatever we have incurred in a given period with the set standards that we had at the beginning, so that we see where to adjust and where not to adjust, and where to focus our attention, and where to control and where to ease our control. So this is actually now where we come in as managers. Now, cost control is one of the basic managerial tools that helps a management in a variety of ways, and thus renders a variety of services. So as you realize, this area is key to us because being managers, we learn a lot, or we get a lot that can help us in making decisions as managers, of which we are meant to. And cost control is one of the tools that we can use to enable us make effective decisions. So these are some of the services or ways we can benefit out of this cost control process. One, measurement of cost and the efficiency cost. Accounting allows for the proper measurement of cost. In other words, cost accounting and cost control measure efficiency and help in cost reduction with a view to improve profitability. Now, things to do with efficiency are just things to ensure that we are producing optimally or we are selling optimally, all right? So that we are not underutilizing the resources that we have. You can imagine having so many employees, you are paying them salary, but at the end of the day, you don't realize anything out of what they are doing, then it is not worthwhile to be in business. So that's why we have to keep on monitoring this and ensuring that we make optimal utilization of the resources that we have. It could be assets, it could be the staff, it could be even the finances. Are we just having finances that are lying idle? What can we make use of these finances? All right. So those are the issues that cost control can help us make decisions about. And number two, labor costs are also minimized due to a proper system of cost accounting and control. A system of timekeeping is introduced over time. In minimum time is minimized. Suitable wage incentive plans are introduced. Okay, so you can see things like introduction of clock in, clock out by members of staff when they are reporting on duty and when they are leaving. Those are some of the controls that can be thought about after ensuring that these are the costs that you're incurring towards that, and there is a lot of wastage. You know, people are spending a lot of time idle. You see, some time that they are supposed to be producing or being productive is spent unproductively. So it is the purpose of this that we come up with such tools that we can use to help us make such decisions. Coming up with incentives, you know, issues of overtime and getting something over and above, but it should be also be managed well, because let people work to their full capacity, not idle around so that they can get overtime. So those are issues that managers can look into, and these are processes that can help us identify such weak areas and check on how we can improve on them. Then we have overheads. In the sphere of overheads, also a system gets introduced. They are determined with accuracy and identified with the cost centers. Now, cost center, we said it could be a department in the organization which is actually there is an expenditure towards that department, and yet it's not generating any revenue to the organization. It's not contributing towards the organization's revenue. So, but there is a maintenance cost that is being incurred by the organization towards that department. Departments like, you know, finance department, they are offering services to the organization, but they are not adding to the revenue or to the profit of the organization. Instead, you are supposed to pay the staff who are operating in that department. So these are cost centers. So issues to do with reduction of overheads, decisions to go with that could be like outsourcing of services. You know, you don't need to have a whole department of accounting. You can have you can hire services from outside, and then you still get probably the same services like you would have at probably a lesser cost than you would have held these people as part of the organization employees. Then plant capacity, the productive capacity of a plant is also determined accurately. An effort is made to have optimum utilization of plant so that average cost gets reduced. All right, so, you know, if you don't check on costs, then you may have a lot of wastage in terms of productive capacity, in terms of the overheads that are being incurred towards this. So it's always good to have this process in place so that we are able to make informed decisions about our cost and how we can control them. Now, in conclusion, we can say that cost accounting aids management in more than one way, right? It's an effective tool of managerial control. This means that costs are identified, deviations from the standard costs are investigated, and ways and means are found to eliminate wastage. So in a nutshell, this is what we can talk about cost accounting, and then how it assists management in decision making. I remember in our definition of management accounting, we said it's a process. It's a process of providing information to managers to enable them make on organizational decisions, because the work of managers is to make decisions, and when it's about how we need to move forward in terms of our operations, then we need to have some data which is given to us through the various systems that we may have in place. For example, the cost accounting systems. Okay, so that is what I can say about cost controls, and this opens up now to go into now the variance analysis. As you can see in our conclusion, we are saying it helps us identify, cost control helps us identify the deviations. Deviations is the same as variations. Deviations can be in terms of the standard deviation, can be here of standard deviation, meaning deviating from the actual and what is expected. Okay, so so we expect to achieve some costs or to incur some costs, but you realize that after the spending, we find that we have overspent or we have underspent. So these are some of the things that help us make decisions as managers. So before I move to the next topic, which is variance analysis, I would like us to come in and bring any suggestions or any clarification if are required. I can provide before we move on. So any question? Any comment? Just raise up your hand and bring up your comment or question. Hello? Hello, are we together?
Yeah, we're
Yes,
together.
doctor.
Okay, so no question, we can proceed?
Of course.
All right, so now let's introduce this area of variance analysis. Okay, so now in light with what we've just been discussing, the cost control, and variance analysis is actually now the technique that we use to...
Doctor, did I miss anything? I just connected now. I was trying since 2:30.
Hello?
Did I miss anything? I just connected now. Mohammed.
You've just connected now, Mohammed. Okay, sorry.
Yeah.
No, yeah, we just finished discussing on cost control. You remember last time it was part of the topics that we had to look at last week, but we were not able due to time and because we had a break. So I was just trying to wind it up before we introduce this new area of variance analysis. So you can just go through the cost control area, then probably when you have a break, as we introduce this, you can bring up, in case you need any clarification, we'll always provide.
Thank you. Thank you, doctor.
All right, welcome. So let's move on. Okay, so I was saying in light with what we've just been discussing, cost control, this is one of the ways that we determine the cost and then be able to compare the cost that we've incurred with what we ought to have incurred as per the budgets or per the standards that we set at the beginning. So variance analysis deals with an analysis of deviations in the budgeted and actual financial performance of a company or an organization. All right. A variance in management accounting may be favorable. All right. When do we say a variance is favorable? All right. For example, if it's a cost, when costs are lower than expected, then we are in a state of favorable. We are in a favorable state. That means we are saving in a way. We are saving, it's a saving to the company because we have incurred less than what we had expected to incur, all right? Assuming that we have also achieved our level of activity that we anticipated to achieve. Now, cost lower than expected or revenue higher than expected. So this is now the indicators that can help managers identify areas of weakness. Because when you look at the budgeted, for example, now let's talk in terms of cost. If you had budgeted to spend, to say, let's say $1,000 in 1 month, but you realize that you have achieved the same item or you've managed to get the same item at a cost of less than $1,000, then the difference between the actual that you spend and what you anticipated to spend is actually a saving to the organization. So that's why we are saying it's favorable to the organization. And that is what we would like us to continue doing, because any organization will be happy with the manager who realizes the targets or the budgets as per the plans, and or the one who surpasses the budget in terms of the sales, but not cost. Because cost, we are supposed to minimize cost as much as we can, and for revenues, we are supposed to maximize revenues as much as we can. So if there are any ways of maximizing revenue, because any organization is there into business because of they want to make profits, isn't it? Organizations would like to see itself growing, expanding in size, growing in sales and all this, with the ultimate goal of increasing the wealth of the owners. All right. So how do we increase the wealth of the owners? Through the sales or profitability levels. When we increase our profitability levels, all right. So that's why we are going into seeking this, so that we are able to identify areas that require emphasis in terms of cost controls. So it can either be from the cost side of the spendings of the organization, or it can be from the revenue side or the sales side of the organization. It can also be adverse or unfavorable when costs are higher than expected or revenues lower than the expected. So expected here is what is budgeted for, all right? Like if you budget for costs and then you find that you are spending more than what you anticipated to spend, then that is a state of unfavorable. It's an unfavorable state or adverse state, all right? It's unfavorable state or adverse state. So we'll not encourage as managers, we should always be looking forward to minimizing such cases of unfavorable, all right? We should always be seeking towards attaining the favorable state in every analysis that we do. So it is therefore the quantitative investigation of the difference between actual and planned behavior. Now, quantitative here can be in monetary terms, can be in quantity terms. Monetary terms are expressed in a currency, like dollars, like beers, all right? And then we have quantities, we can have like kilograms, all right? Kilograms, like the raw materials can be in terms of kilograms. We can express the quantity in terms of the units produced, all right? So these are the things we are talking about. So we express them in terms of, in quantitative terms. And this, why quantitative? So that it enables us make a decision based on the quantitative figures. Anything that is expressed in monetary terms is actually easier to relate with in terms of decision making, because we are making decisions currently, right? And the decisions we are making can easily be expressed in monetary terms than just in theoretical terms. Okay, this analysis is used to maintain control over a business operations. So why do we do the analysis? We're already appreciating that it helps us to manage and control operations over the organization, as we had alluded earlier on. Okay, now let's look at this typical example. If you budget for sales to be $10,000 and actual sales are $8,000, our variance analysis yields a difference of $2,000. So this is unfavorable because we had planned $10,000 in terms of sales, but at the end of the period, we have only realized 8,000 in terms of sales. So we are less by 20% in terms of attaining our targets. All right? Or our performance level is 80%, in other words. So this is a state of unfavorable. And that's why you realize you determine a figure and then you find at the end, we indicate whether it's favorable or unfavorable. So for a manager, it's important that you focus on the areas of unfavorable and look into them to find out the cause why we did not make our sales surpass the 10,000 or the 10,000 that we anticipated to achieve. What went wrong? So when you look into that and you find the reason why we did not achieve our target, then there will be need to investigate and check for areas of weakness that you need to improve on. The same scenario can happen with costs. If the actual sales are, assuming the actual sales are 13,000, variance analysis yields a difference of 3,000 because it's actually 13 minus 10,000. So our variance analysis yields a difference of 3,000. And this 3,000 is favorable because we have surpassed our target, and which is always good for the organization. When we surpass our targets in terms of sales, then our performance is actually 130%, right, above average or above 100%. If such analysis is not carried out in regular intervals, it may cause a delay in the management action to control its costs. So that's why it's important as managers, we get this information at every small interval. So the costing process should be continuous, all right? And the accumulations are continuous, probably on monthly basis, and then the variance analysis be done on continuous basis and identify areas of weakness. All right, so that we are able to address the problem before it's too late. And that's why it is important that we understand how variance analysis is carried out and on which items that we can do the analysis. I hope we now understand the difference between favorable and unfavorable state. Of course, with cost, if we surpass the planned cost, that is unfavorable. But with the sales, if we surpass the sales targets, then that is favorable. Advantages of variance analysis. Of course, this you can add more. You're not limited to this. But in a nutshell, it helps managers in making efficient, detailed, and forward-looking budgetary decisions. So they help us make efficient decisions, detailed and informed decisions, forward-looking decisions, because we have a basis for which we are making our decisions. And that's the work of management accounting as we introduced at the beginning. It acts as a control mechanism. Analysis of significant deviation on essential items helps the company in knowing the causes, and it helps management look into possible ways of how much deviation can be avoided or reduced. I'm sure we appreciate this because after doing the analysis, we are able to identify these areas that require possible intervention and a better way to reduce costs or to increase our sales. Now, again, it facilitates assigning of responsibilities and engages control mechanism on departments. For example, if labor efficient variance is seen to be unfavorable, or procurement of raw material cost variance is unfavorable, the management can enhance control of these departments so as to increase efficiency. So through this process of variance analysis, we are able to, ensure that our resources are put into full capacity. For example, the machines, all right? Now, like this example, the labor efficiency. How do you ensure that there's labor efficiency, all right? By probably introducing the clock-in clocks, clock-in and clock-out gadgets, ensuring you can put in the CCTV and monitor the staff as they are working. So these are mechanisms of trying to see how we can effectively utilize our resources in terms of labor and in terms of machines. So we note that if the budgeting is not made, taking into consideration the detailed analysis of each factor, then the budgeting exercise may be loosely done. As a result, this is bound to deviate from the actual numbers, which may render variance analysis not a useful activity. So it all starts with budgeting, all right? So if you don't budget properly, if you don't consider the key factors affecting the budgeting process of the organization, then the whole process of variance analysis is useless, because you will end up getting figures in the budgets, figures that are unrealistic, all right? And then now, with unrealistic figures, and after comparing with the actual figures, then you find that the process becomes useless to the organization. and even the decision-making process is faulted because of the process, the budgeting process that was put in place when the budgeting was done. So it's important that budgeting is critically looked into. That's why it's always given enough time and enough consideration before approval is done, because it speaks a lot about the organization. It speaks a lot about where the organization wants to be in the next period. So things have to be done in a correct way from the word go. And remember, it's a plan of action. So it's done at the beginning of the year or at the beginning of the period. All right. And then the implementation comes in after that. So once you arrive at those figures through the budgeting process, it is critical that we consider the various items that may affect those figures before giving the proper estimate that can be compared with the final figures that we get after the implementation. So that's why we note that any problems with the budgeting may also affect our variance analysis process, because it always starts with the budget, because that is the starting point, is the benchmark. In other words, the benchmark that we use to compare with what we have actually incurred. Now, types of variance analysis. Variance analysis can be broadly classified into following heads. We have material variance. We have under material variance, we have material price variance. We have material usage variance. Then number 2, we have labor variance or labor cost variance. Labor rate variance is one of the variance analysis that is done under labor cost variance. We have labor efficiency variance. Then 3, we have variable overhead variance. Under variable overhead variance, we can compute the variable overhead efficiency variance, variable overhead expenditure variance. Then we have fixed overhead variance. Fixed overhead variance, we have fixed overhead expenditure variance and fixed overhead volume variance. Then we have sales variance, which we can talk about sales volume variance and sales price variance. So in a nutshell, how many variances do we have? Variance items that can be computed where we have a full functional organization. We have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. All right. So you'll find in most cases, you may not be asked to determine all of them, but just a few, depending on what you have been given as part of the information that will help you determine each one of these. Now, variance determination formula. The general formula for variance determination is given as standard or budgeted expense with less actual expense. You remember I said the purpose of analysis is to benchmark whatever we have realized or whatever we have incurred at the end of the period with what we had budgeted for or with the standards. So we always start with the standards or the budgets. So this is very important because it will always determine whether the results of the comparison or the variance calculation is favorable or unfavorable. All right. So we always start with the standard or budgeted figures. Then we less the actual to determine our variance. So if it's negative, if the answer of this is negative, then you will give an unfavorable state. If it's positive, then you give a favorable state. And note here again, standard cost refers to a specific cost per unit, while budgeted cost refers to costs in total given a certain level of activity. So that's basically the difference. You can compare the actual with the standard, all right? You can compare the actual with the budgeted. So you realize the standard and budgeted normally play the same role because one is developed out of the other. We actually use the standard rates to develop our budget because if you know the rates and we anticipate to produce a level of activity, then we can always compute our expenditures in terms of budgets, all right, and use that to guide our analysis at the end of the period with the actual that we have incurred or realized. Standard costs are used to establish a flexible budget based on a given level of activity. They are used to establish a flexible budget. We know now what a flexible budget after talking about budgets and types last week. We can tell what a flexible budget, you know, we said flexible budget is the one that is normally less than 1 year or 1 year, and it can be modified. It can be adjusted. It's flexible. It can be adjusted with time, and then monitoring is done closely because that's why we have to do some adjustments in case we need to, so that we can move forward. Now, before we look at go into details of understanding and how we can determine these variances, I would like us to take a break and probably discuss, if there are any issues that may call for clarification. We can do that before we go into understanding now each of these variance analysis procedures that we are likely to face whenever we are doing variance analysis. Okay, any comment, question, clarification?
No.
Hello? Hello? Are you with me?
Yes, we are.
Yeah, any question, comment? Hello? Who can probably tell us or help us understand the purpose of variance analysis? Why do we have to do variance analysis? Just a question to think about. Why do we have to do variance analysis as managers and people who are supposed to make decisions for organizations? Mohammed, are you there?
Yes, I'm here.
Yes.
I'm hearing you.
Yes.
One of the purpose of the variance analysis is to know the management performance in the production or in the sale, so that the proper action or decision can be taken on time.
Yes, that's good.
Thank you.
So that we have to make informed decisions and in timely manner.
Yes.
Bekele, yes, Bekele. Bekele. Yes.
Yes. Yeah. As Mohammed has explained, it helps us to look how we are performing, how our company is performing, and to make the proper adjustment, whether on our budgets or whether on our plan even. If we have defective plan, we will adjust that one based on the various analysis we have made. If the budget is problematic, we will look and make efficient ways of adjustments. I think this is the basic purpose of making variance analysis. Thank you, sir.
Thank you. Very good. That is actually the main purpose of budget analysis. Variance analysis. Any other? Solomon, you want to say something? Solomon? Where's Tina?
Yes, doctor.
Yes.
Variance analysis means it is a quantitative method that describes the organization performance to compare the actual in the budget. That analysis gives to perform a better production or any activity or services to control our performance purpose of our organization, I think. That's all.
Okay. Thank you, Westina. Anybody else? Now, we've just talked about the general formula for determining the variance so that we can tell whether it's favorable or unfavorable. So what do we understand by favorable variance and unfavorable variance? All right. In terms of the variance analysis that we do.
Yes, doctor.
Yes, Miguel. Go ahead.
The favorable, if the variance analysis is favorable, that means we are performing in good ways, but we have to be cautious. Sometimes the costs will decrease, the revenues will increase. This indicates that we are performing based on in relation to our budget or in relation to our set standard. So we may go back and see how our standard is set, whether we have problem there also. This can help us to look back. Thank you.
Thank you. Yes, well stated. Everybody else? So you, as he says, you have to be careful. What are you talking about? Is it in relation to the sales? Is it in relation to the cost? All right. So if it's in relation to the cost, then are you able to tell when it's favorable and when it's not favorable, or when it's adverse?
Can I have a question?
Yes, Mohammed. Yes,
okay,
yes.
Thank you, Doctor. This analysis method, I think it shows us more on the financial part, something which is planned. When we say favorable or unfavorable, it may not be showing maybe the future of the business. I mean, currently we may be selling a good amount, even more than what is planned, but the customers may not be satisfied with our goods and products, and our value may be decreasing under the eye of the customers. So in the future, we may be affected. So is there any additional method that can show us, or that we can apply to see as a manager other factors too? For example, customer satisfaction and our quality, good quality in the market. Is there any additional method, or we have to depend on this analysis only?
Okay, that's a very good question, Mohammed. Who can help us or help Mohammed address that question? Well, there are possible other means that we can always check on that, other than just relying on the variance analysis, and when it's favorable, we're always happy, and yet things may not be going well outside there. Yes. And I think this yes, Bakele. Bekele, go ahead.
There has to be other ways of testing the customer satisfaction. The variance analysis helps the company and the management how we are performing, how we are doing, whether our sales are going up or whether we have problem in our costs, and how to solve those issues. Relating to the customers, there has to be other mechanisms. We have to we have to devise our other mechanisms to assess the customer satisfaction. Of course, producing a lot may create customer dissatisfaction by itself, based on the quality or others. So we have to check the quality of our products. We have to check the service quality of our company. I think this has to be done. Thank you, sir.
Thank you. Yes. So the other means that we can always get this done, other than the just analysis of the performance. Like he says, we can also do a market analysis. All right. Market analysis you don't have to do when you are doing badly. You even when you're doing well, you must continue doing it. You as managers, we are supposed to be strategic. That's why we have to always apply the SWOT analysis. We have to do the SWOT analysis. I am sure you understand what we mean by SWOT analysis, where you have to look at your strengths, your weaknesses, your opportunities. All right. So it can be, for example, like government organizations. You find most of the services that are rendered through the government. I don't know whether it's also with Ethiopia, but in Kenya, you find power is normally provided by the state corporation, so that you find that when you have like a blackout, you have nowhere to go. You can't engage a private supplier of power, because it's generally the Kenya Power and Lighting which is charged with this, and it provides the power throughout the country. So when there are no alternatives, when there are no alternatives, you find the people are actually left with you alone, and that can be the reason why your sales are always up. So there are other factors that need to be considered. Are people satisfied? Like you can do a market survey, customer satisfaction, so that we always keep on improving. Whether we are making good sales or all our sales are favorable, but we must keep on improving. And I'm sure as students of management, you have learned these things. But what you are saying is variance analysis is just one of the performance analysis. If you remember the scorecard, it's called who? The balance scorecard, isn't it? There are other aspects. This is just financial performance aspect, all right, which is actually core, because it's at the bottom line, we all think about finances. If we have to do anything, we think about finances, including even if we have to do a market survey, isn't it? If you have to carry out an advertisement or carry out a market survey, it involves money, all right? So that's why variance analysis is critical in all these processes, because it is actually the one that facilitates these other processes. However, There are many other processes that we can use as managers to keep on improving, all right? And to keep on improving, and that's why we need to surpass our targets. You know, favorable is only, other than favorable, you're breaking even, all right? If you break even, then you are operating at a cost is equals to sales level, all right? But we need to surpass so that we increase our profit margin, all right? We increase our profit margin. So how do we increase our profit margin? By doing other analysis. You do a market analysis, see how people perceive your product, and all these things are part of management decisions that you have to make. So I would say, Mohammed, there are other avenues that we can help us improve our performance other than the financial performance that we are using here. All right?
Thank you. Thank you, Doctor. Thank you.
Any other comment? There was somebody who had raised a hand. Was it Johannes? Are you there?
Yes, yes, I'm here.
Yes. Can you comment something?
I think it's all clear for me, Doctor.
It's all clear for you. Okay. Was it Solomon who had raised the hand? Solomon? I think it's disappeared. Okay. So so these are now the areas we are going to focus on. See how we can compute this because it involves formulas. And as I said, for us to tell whether it's favorable or unfavorable, our benchmark is always the budget, right? If we are deviating from what is budgeted, then that is unfavorable in terms of cost, all right? In terms of cost. If you are incurring more than what we had budgeted, then that is unfavorable. But if we are, Demiseu, yes, come up. Demisa?
Yes, Doctor.
Yes. I saw you had raised your hand.
Yes.
Yeah.
Can I ask one question?
Sure.
Okay. Income is, I think, comes from revenue minus expense, I think.
Yeah?
Income. We said here standard income.
Or
budgeted income. Yeah.
Yes.
Budgeted income less actual income. Income is come from revenue minus expense, I think.
No. We are talking about sales or revenues, not income. Income is actually the same as profit.
Okay.
So we are talking about the sales figures.
Not the net income? Not the net income?
Not net income.
Okay.
Yeah. Net income is actually a result of comparing revenues and the costs incurred to generate those revenues. So it's actually the difference between cost and revenue. All right. So when the costs are more than the revenue, then we have a net loss. And when the revenues are more than the cost, then we have a net income. So we are not there. We are not talking about that. We're just talking about the sales volume, isn't it? The sales volume and the cost that we have incurred in totality.
Okay, Doctor. Thank you.
Okay. Any other question or clarification?
በትምህርት ከፍ ብሎ መብረር ይቻላል። ናሽናል አቪዬሽን ኮሌጅ የናሽናል ኤርዌይስ እህት ኩባንያ ከከፍተኛ ትምህርት አግባብነትና ጥራት ኤጀንሲ ሙሉ ዕውቅናን ባገኘንባቸው በማስተርስ ዲግሪ ኤምቢኤ በስትራቴጂክ ማኔጅመንት፣ ኤምቢኤ በባንኪንግ እና ፋይናንስ፣ ኤምቢኤ በቢዝነስ ሊደርሺፕ፣ ኤምቢኤ በሪስክና ኢንሹራንስ፣ ኤምኤስሲ በኢንተርናሽናል ትሬድ እና ኢኮኖሚክስ ዘርፎች በእውቀት ለመቅረጽ የበቁ ፕሮፌሰሮቻችን አረንጓዴ መብራታቸውን አብርተዋል። በነገራችን ላይ በኬንያ ሀገር ከሚገኙ ስመጥር ዩኒቨርሲቲዎች በሚመጡ ፕሮፌሰሮች የትኩረት መስክ ትምህርቶቹ መሰጠታቸው ልዩ ያደርገናል። በምርጥ የትምህርት ስርዓት የተገነባው ናሽናል አቪዬሽን ኮሌጅ በመጀመሪያ ዲግሪ በአቪዬሽን ማኔጅመንት፣ በሆቴል ማኔጅመንት፣ በአካውንቲንግና ፋይናንስ፣ በማርኬቲንግ ማኔጅመንት አስተማማኝ ትምህርት ይገቢውና ራስዎንና ሀገሮን ይለውጡ። አድራሻ 22 አደባባይ ወደ ሾላ በሚወስደው መንገድ ላይ ናሽናል አቪዬሽን ኮሌጅ የናሽናል ኤርዌይስ እህት ኩባንያ ህልሞን እውን ያደርጋል።
Okay, so as I was saying, this various variance needs to be calculated, and I was talking about the key formula which we use, and I said that our benchmark is always the standard figure or the budgeted figure. So when you compare with the actual and you get a negative, then that becomes unfavorable in terms of cost, and if it is positive in terms of revenue, that is favorable. Okay, so then allow me to just move on and look at probably how we can determine, starting with the material variances. Each of these class of variances, starting with the material, and probably I'll share the screen so that we are together. Material cost variance. What is material cost variance? And material here, normally material refer to the raw materials, because this is where we are talking about the direct costs. Material that we buy for processing into finished goods for sale. So materials can be in form of kilograms, can be in form of liters, can be in form of whichever, all right? Depending on, in form of meters, in form of, depending on the nature of operations you're involved in as an organization. So this actually will determine what you are referring to as material, right? If you are producing chairs, then what are the raw materials that you may buy? It's timber, probably metal, bars, all this. So all these things that can be combined to make a chair are part of the materials we are talking about. And this is basically referred to as the direct cost of material. So this involves the analysis of the difference between the budgeted cost of direct materials and the actual cost of direct materials that an organization uses for production. Here we have, we can, if we know the cost of kilogram, the cost per kilogram of material that we require to buy in a given period, and we know the quantity of the material that we require for production for a given period, then we can always get the total cost or the budgeted cost for the raw materials by multiplying the cost per kilogram of the material times the number of kilograms that we require for that particular period to get the total cost of raw materials. And this is now what we can budget for that particular period. So at the end of the period, we'll have incurred some, probably we paid more or less per kilogram. Then there is need to do analysis to compare this variance, to get the variance or to get the difference, so that we can analyze the difference and see how we can improve in terms of probably there's something we need to factor in as we plan or as we budget for future. Now we have material cost volume formula. The main formula for material cost volume is standard cost minus actual cost, or budgeted cost minus actual cost. Okay, so it's either standard or budgeted. So budgeted cost minus actual cost. That is the material cost variance formula. Now, standard cost, how do you determine the standard cost? We determine standard cost by taking the budgeted quantity or by taking the standard quantity, because it can be either standard or budgeted quantity for actual output. Budgeted quantity for actual output times budgeted price. So, or standard price. Okay, so I'll be, when I use budgeted, is the same as standard, depending on what you've been given, but look at them as the same because one drives the other. So it can be in unit form, it can be in volume form. Then actual cost is equals to actual quantity times actual price. Okay, actual cost is equals to actual quantity times actual price. Then we have material cost variance is further divided into material price variance, which is actually represented by MPV. And this one is given as standard price minus actual price times actual quantity, or budgeted price minus actual price times actual quantity. Then material usage variance, as we had mentioned earlier, these are some of the variances that you may find. Material usage variance is given as standard quantity for actual output minus actual quantity times budgeted price or standard price. Now, it's important that you understand, and as you practice with this, you'll realize that you don't need to even cram the formula. Once you are asked this one, you know this is what you need to look for, all right? So that's why it's important that we do some of these things practically so that we come to appreciate them and think about what analysis that can be given with the results that we get, all right? I'll suggest some of the ways forward. Now, this illustration, assume a scenario of a company having the following budgeted and actual figures. Okay, or standard and actual figures. Actually, they are standard and actual figures, but it can also be budgeted and actual figures. Now, price per kilogram. Now, price per kilogram is actually the buying price. The buying price per kilogram, which is $10 per kilogram. And the actual that we incurred is $8 per kilogram. Now, quantity is 200 kilograms. This is now the standard quantity. 200 kilograms. Standard quantity is now what we require for that period or for that production. We need like 200 kilograms, but our quantity that we utilized were 150 kilograms. Then our hours, the labor hours is 250 hours, 300 hours, standard and actual. Our labor hours rate is $8 per hour and $7 per hour, that is the actual. Then output, that means the production level, is 10 kilograms and 8 kilograms actual achieved. Then fixed overhead rate per hour is given like $12 and 11 point what that dollars. Fixed overhead rate per unit is $30 and $43.75 actual. The fixed overhead is actually $3,000 and $3,500. actual. Now, our sales price per unit is $50 and actual is $65. So these are now the standards that you've been given and which you need now to compare with the actual. In this case, you have been given the standards and the actuals. So we'll be comparing the standards and the actuals. In some certain cases, you'll be given the budgeted and then now the actuals. So the budgeted replace the standard. However, the formulas do not change. Now you're asked to determine and advise the following and advise. 1, the material cost variance. Then 2, the material price variance. And 3, the material usage variance. Okay. So now we'll be using the table or getting the figures to use in these formulas from the table. And what is important is how we get these figures and that we finally add up or divide, subtract so that we finally subtract so that we get the variance. So starting with the material cost variance, we know the formula is standard cost minus actual cost. And our standard cost is given as standard quantity for actual output times standard price. Now, how do you determine the standard quantity for actual output? From our table. Standard cost is given as standard quantity for actual output times standard price. So our standard price for material is 10. Our actual is 8. Okay. Our quantity is 200 and our actual is 150. Now, standard quantity is the standard quantity according to our table. The standard quantity is 200. And actual output is 150. No, actual output is 80. And actual output is 80. All right, actual output is 80. And then our standard output is 100. Our standard output is 100. Okay, so standard quantity for actual output times standard price. Standard price is 10. Standard price is 10. So how do we determine now our standard quantity for actual output? Our standard quantity is 200. All right. Our standard quantity for actual output. Standard quantity for actual output is 200 times actual output is 80 out of 100. So actually we achieved 80% instead of the 100 that we ought to have achieved. So it's 80 out of 100, all right, times the standard price. The standard price is 10. So it is 200 times 80 over 100 times 10, which will give us 1,600. That is our standard cost. All right. Our actual, Hello? Our actual cost is given as actual quantity. Our actual quantity is 150 times actual price. Our actual price was 8. 150 times 8 giving us 1,200. 1,200. So if you look at our material cost variance, we are taking the 200 times 8 over 10 or 80 over 100. It's actually 8 over 100, not 8 over 10, times 100 times 10, which gives us 16. And then now the actual cost is 150 times 8, which is 1,200. So the material cost variance is the 1.6 minus 1.2, giving us 400. So 400 is favorable because we are looking at the answer we get is positive, and its cost we are analyzing. So if it's positive, then our state is favorable in terms of material cost variance. Our state is favorable. I hope we understand this, but I will clarify that when you take a break. Now, for material price variance, it's actually standard price minus actual price times actual quantity. So our standard price was 10 minus actual price, which is 8. So it's 10 minus 8 times actual quantity. What is our actual quantity? 150. So it's actually 2 times 150. 10 minus 8 giving us 2 times 150, giving us 300. So 300 is favorable. You can see 10 is more than 8. And when you less, you get a positive answer. So this is favorable. And you can see our whatever our standard price, whatever price that we are supposed to be paying is more than what we actually paid. And this is favorable for the organization because this is a cost. Then we have standard quantity for actual output. The material usage variance is given as standard quantity for actual output minus actual quantity times standard price. Now our standard quantity is 200, 100. Our standard quantity. No, it's 200, sorry. Our standard quantity is 200. For actual output, that is 200. Actually, it's just like what we did up there, times 8 over 100. All right. Then this is minus actual quantity. Actual quantity is 150. All right, times standard price, which is 10. So it is actually the 200 times 8 over 100, which gives us 160. And actual is 150. So the difference is 10 times 10, which is the standard price, to give us 100. So 100 is favorable. 100 is favorable because you can see 160 is actually the budgeted. And the quantity used is 150. So this is favorable. This is favorable. So these are things that probably we need to practice a lot so that understand how these figures are derived. But it all depends on what you've been given by the examiner. Like now, what you've been given, we are just using the figure that you've been given there. But what matters is, are you taking the right figure to compute the right variable? Okay, because at the end of the day, you get wrong figures to compute the variance. You may end up getting a wrong variance, and that will give us a wrong decision in terms of favorable or unfavorable. Okay, let me go back to comments or questions. Any clarification? This is now issues to do with computing the variance. Any question? Are we together?
Yes.
Yes, no questions? Any question? Mohammed, you okay?
Yes. Yes, Doctor.
Johannes?
Yes.
So if you get a question on determining the material cost variance, it's not an issue here. And interpreting the results. So the advice that we're talking about here is now telling the management this is favorable, this is unfavorable, or managers saying this is favorable, this is unfavorable, by looking at the results of the analysis of the variance so that they can now do analysis. Variance is actually, you determine the variance and then the analysis follows after determination of the variance. That's why it's called variance analysis. Any comment, question? Moges?
No question, Doctor.
Okay. So we can finish up with the one for labor. Then we'll do the rest of the analysis items probably tomorrow. Now, labor variance. Labor variance arises when there is a difference between the actual cost associated with a labor activity from the standard cost. So labor cost variance formula is given as standard wages minus actual wages. And how do you determine standard wages? Standard wages are determined by standard hours for actual output times standard rate per hour. And actual wages are given as actual hours times actual rate per hour. Now, labor variance is divided into two. We have labor rate variance. Labor rate variance is standard rate per hour minus actual rate per hour times actual hours. And the labor efficiency variance is given as standard hours for actual output minus actual hours times standard rate. So standard rate or budgeted rate. Now, we are to determine the same for like what we did for materials, the labor cost variance, the labor rate variance, the labor efficiency variance. Now, from our formulas up there, we saw that LCV is given as standard wages minus actual wages. So how do you determine the standard wages? So standard wages is determined by standard hours for actual output times standard rate per hour. And then actual wages is actual hours times actual rate per hour. So, so from our table, now the table we have up there, what are our standard hours? Our standard hours, according to our table, 250. Our standard hours are 250. And then actual is 300. Okay. Our output remains the same. Actual is 80 and 100. So standard hours for actual output is actually 250, which is actually the standard, times 80 over 100, times 80 over 100. So standard hours for actual output times standard rate per hour. Standard rate per hour was 8. So when you work out that, was it 8? Standard hour, yes. Standard hour is 8. No, standard hour rate is 8. So it's 250 times 0.8 is 200 times 8 would give us 16. So that gives us 1,600. Actual wages is given as actual hours. Actual hours is 300 times actual rate per hour. That is 300 times actual rate per hour, which is 7. Then you get your 2,100. All right. So you compare for labor cost variance, you compare the 1.6 and the 200 and 100, the 2,100. You can see the 1,600 is less than 2,100 and giving us a difference of 500, which is negative 500. So because of the negative, then our state is unfavorable because this is in terms of cost. The state is unfavorable. For standard hours, labor rate variance, standard rate per hour, which is 8, minus actual rate per hour, which is 7, times actual hours. Actual hours is 300. So it is 8 minus 7 giving us 1 times 300 giving us 300. So 300 is favorable because 8 is, our answer is actually positive. So if it's positive, then that is favorable. Then we have the standard hour, the labor efficiency variance, standard hours for actual output. So for this one is just the same like we've done there. 250 times 80 over 100. Standard hours for actual output minus actual hours. Actual hours is 300. Times. So if you do that, you'll have 250 times 8. This is supposed to be 8 over 100. 8 over 100, not 80. 80 over 100. So this so actual hours, so there's supposed to be 1500. I think there's a mistake here. So I it's supposed to be 16. Eh? So when you multiply, wait a minute. I think there's a problem here. Standard hours for actual output, which is 250. That is 250 times for actual output, 80 over 100. It's 200. 200. Actual hours for actual output minus actual hours. So 200 minus 300, giving us 31. Minus actual hours times standard rate. Times standard rate. Standard rate is 8. That is negative 800. So I think there's a problem here. It's supposed to be, this is supposed to give us 200 minus 3, giving us negative 1. Negative 1 times 8 gives us negative 8. So because it's negative, this is negative, we're supposed to get unfavorable. So correct this. If it is given the way it is, it's supposed to be 80 over 100, not 8 over 100. 80 over 100. Yes. So this is unfavorable because you can see 200 is actually a lesser figure than 300. And when you multiply by 8, you get a negative. So the 800 is negative, and therefore our state is unfavorable. So that is what you need to do with the material and labor. We still have the others like the overheads, the variable and fixed, and also the sales. So any questions before we continue with something else? Any clarification? Are we together? Hello?
Yes, yes.
Okay. Any question?
Yes.
Yeah, come up. Yes. Who is talking? Hello, anybody talking? Okay, so if no question, no clarification, I think we'll continue tomorrow with the other items that we've not addressed today. And then we'll do now a comprehensive practical illustration that probably we are likely to get in future or as part of our work, so that we get acquainted to some of these analyses as they come. Now, I've received quite a number of your assignments, particularly the first assignment. I hope everybody or all groups have submitted. I plan to start working on them probably on Monday. And next week when we meet, I'll be able to give feedback after going through the assignments, and if there will be any areas or key points that I'll need to highlight, I'll do so before we continue with our next week's class. The assignment 2, I've also received some, though some have not come yet. So I think for those ones who have not submitted, please do so, so that we are able to finish on assignment 1 and assignment 2, and look forward to now the last assignment as we had agreed, which probably will come after we've done this topic. Otherwise, I intend to stop there. If there are any comments, I'll whatever discussions that you're going to do for tomorrow, I hope I'm going to share tonight, so that you're able to go through them before our tomorrow's class. And that will be good, so that we'll be together as we continue looking into determination of these variances, and then thinking about how we can do the analysis of them. Morgus, do you have anything to say? I want us to stop here for today. Morgus? Hello? Hello, Morgus? Can you hear me? Can anybody say yes?
Yes. Yes, Doctor.
Yes, Doctor.
See, Morgus is disappeared.
Yes, Doctor.
Yeah, I want to hear people talk. Huh? The floor is open now. The floor is open.
Thank you for your time.
Yes, now.
Thank you, sir.
Okay. So I'm just requesting those ones who have not submitted their first assignment, please do so, because from Monday I'll start working on the ones that I've received, and I want to, once I start working on them, I do it once and for all. So make sure you submit latest by Monday. Do you have some people who have not submitted yet, the assignment 1? Okay, so let's stop there for today, and hope to see you tomorrow at 10:30 as usual. All right, as usual up to 12, and that will be what we shall discuss for tomorrow. So I'll share, as I've promised tonight, the discussions for tomorrow. Thank you so much, and have a good evening.
Thank you, doctor.
Thank you.
Bye.
Have a good.
Thank you.
doctor.
ልዩነት መፍጠር ዓላማችን ነው። ዓለም አቀፍ ተወዳዳሪ መሆን አለባችሁ። የናሽናል ኤርዌይስ እህት ኩባንያ ናሽናል አቪዬሽን ኮሌጅ ጥራትና ደረጃውን የጠበቀ ስልጠና በመስጠት ብቁ ዜጋ እያፈራን ነው። በፍላይት ኦፕሬሽን፣ በበረራ መስተንግዶ፣ በቲኬቲንግና ሪዘርቬሽን፣ በሆቴልና ቱሪዝም ሙያዎች አሰልጥነን ተወዳዳሪ እናደርጉታለን። ኮሌጃችን ካናዳ ከሚገኘው ኢንተርናሽናል ኤር ትራንስፖርት አሶሲዬሽን አያታና ከእንግሊዙ ICM ጋር በመተባበር ዓለም አቀፍ ዕውቅና ያለው ስልጠና እየሰጠ ይገኛል። በፍላይት ኦፕሬሽን፣ በበረራ መስተንግዶ የምንሰጣቸው ስልጠና ከኢትዮጵያ ሲቪል አቪዬሽን ባለስልጣን ሙሉ ዕውቅና አለው። አድራሻ ከጎላጉል ታወር 22 አደባባይ ወደ ሾላ በሚወስደው መንገድ ላይ የናሽናል ኤርዌይስ እህት ኩባንያ ናሽናል አቪዬሽን ኮሌጅ ህልሞን እውን ያደርጋል።